Now, there's always ways to make money in any market, regardless of if it goes up or if it goes down. So don't ever think by any stretch of the imagination that everyone here in these times is complaining about this decline. As you know, you can come in here, you can buy some puts. You can buy puts against the indexes, the QQQ, DIASPY ETFs, which represent the stock indices. You could have bought puts on those indices, and you could have made money all the way down. Okay, if you had perfectly timed the decline of the Dow, of the S&P, of the Nasdaq, you could have profited on those put options very nicely on that decline. Alternatively, you could have chosen any specific stock, Apple, Facebook, Netflix, Google, my favorites. In this particular case, we've seen Netflix fall quite dramatically. Uh, Apple's fallen quite dramatically here. You could have come here and you could have bought uh, these put options here, and you could have made a great deal of money here on this decline down. Okay, you know, someone who had come out here and bought some longer dated options. They were seeing some decent returns here on their capital, okay, for about a couple of weeks of downward movement. Okay, you'll never hear me mention anything about buying puts or shorting. The reason why I will never buy put options or short is because stocks are not meant to go down, they're meant to go up. Okay, so to buy a put option is much more of a speculative move. You're basically uh, betting on a stock doing something that goes against its very nature. The nature of the stock market, why it was created, was for companies to raise capital. The stock market is a source of funding, okay, for companies. Okay, there's two markets: primary market and secondary market. We're trading in the secondary market, but in the primary market, the IPO phase, the purpose of the stock market is to provide a source of liquidity for companies. With that being said, um, I will not buy put options. If I'm bearish, I stay out of it. I stay out and I wait. Okay, if I'm bearish, I do not short and I do not buy puts. However, in this particular market that we're in, this would have worked out really well for you. Another way that is a little less risky than puts, buying puts, that you can make money on the way down and also make money also make money on the way up is you can do something called a straddle. And what a straddle is essentially, let's choose March 2nd, for example. You are basically buying a put and a call simultaneously with the same strike price and the same expiration date. Okay. And basically, what that's going to do is give you the opportunity to profit on the movement of that stock, whether it goes up or whether it goes down. Okay. Now, obviously, the expiry that you choose is going to determine what your margin debit is. Also, you can see here that by buying both a put and a call, it is much more expensive than by buying a put or a call. So this strategy is called a straddle. And by doing a straddle, you have the opportunity to profit on the way up or on the way down. So in this particular case, if you had done let's say a March 185 straddle on Facebook, okay, then that would have cost you for one contract would have cost you $1,500. Well, actually, in today's prices, would be a $1,500 debit. Okay, so in other words, for this straddle to be profitable on either side, okay, it has to exceed the break even point, which is in this particular case, the 185 plus the 1290, okay, on the put side, or the 185 plus the ask price of 217 by March the 2nd. If it has to be above, okay, that the sum of these two numbers in order for the call side to be profitable, okay, or for the put side to be profitable, it has to be the sum of 185 plus 1290 on or before expiration date. So the sooner that happens, you can close out one of the other sides of this transaction, and you can basically uh, more or less make money without really knowing what's going to happen. This is really good if you're trying to play earnings. If you're someone who is wanting to do earnings plays, I know a few people in the group. I think Marvis likes to talk about earnings. If you wanted to do one of these deals right here, Marvis, you can come in here and just do a straddle. You don't really need to know exactly if it's going to be up or down, as long as it exceeds the sum of the strike price and the and what you paid for it, okay, on or before the expiry that you chose, that side of the strata will be profitable. Okay, so that's pretty much it. So you can do a straddle when you're in these crazy market conditions. You want to capture some of that downside, but you're not as risque as a naked put option buyer. You can do a straddle if you want to capture the downside with less capital outlay. You can buy a put option, or you can do like I do and stay the hell out of the market if you don't know what's going to happen.